Thanks for clicking. We had an interesting week in China's real estate/growing economic crisis this week, as weak economic data from China's largely locked down economy continues to emerge. We also saw the People's Bank of China, the PBOC, continue to loosen restrictions on China's real estate market, as the COVID lockdowns are definitely taking their toll on the already weakened Chinese real estate market.
Am I a disappointment?
Finally, seeing the worst case of capital outflows, that is, foreign money leaving China since 2015. China has stopped publishing data on bond trades to foreigners. So what I want to do today is go over China's economic data from April, showing major declines in the country's economic output. Then I want to go over the PBOC's loosening of restrictions, as China's real estate market has experienced its first year-over-year drop since 2015 and the largest decline since 2006. And then take a look at China's decision to cease the publication of capital outflow data due to the massive exodus of foreign money as of late. Slowdowns in China means higher costs of production, which translates into higher prices in the US and in Canada, which will contribute to our already decades-high inflation rates and the problems we are experiencing here at home. As such, we'll continue to go over China's real estate and growing economic crisis every Friday on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into this economic data. We talked last week about China's economy weakening, due in large part to the zero COVID policy, which put millions of people out of work. And data from April is starting to show the effects of this zero COVID policy on China's economy. Data came in this week showing that industrial output had tumbled 2.9%, retail sales were down 11.1%, and their unemployment rate was up to 6.1%.
Things are good.
And we've talked about China's transparency problems before. Even with this dismal economic data, many are suggesting that the numbers on the ground are probably much worse than China is letting on. Following the release of this data, China received multiple downgrades from the major analysts, with Goldman and Sachs predicting that their GDP would drop from a 4.5% projection to 4%, and Citi also dropping their projections down from 5.1% this year to 4.2%. And this is a big deal for China, who has pledged to hit a 5.5% GDP growth for the remainder of this year. However, despite worsening economic data and pleas from stakeholders for the PBOC to open up the taps, lower interest rates, open up monetary policy support, the PBOC maintained its key interest rate over concerns of capital flight, which we'll get to in a few minutes. With that said, Beijing is still trying to jumpstart the country's real estate market, which underwent its 8th straight month of price drops in April. Indeed, new home prices dropped by 0.3%, with China experiencing its first year-over-year drop since 2015 and the sharpest decline in sales since 2006. So China's real estate market continues to flounder.
That's one way to put it.
At a time when China's real estate developers are undergoing major defaults across the board. As a result, the PBOC announced this week that they would be lowering mortgage rates for first-time home buyers by 20 basis points, hoping that it will work to induce at least some buyers back into the troubled real estate market.
The PBOC cutting the lower bound range of mortgage interest rates Sunday by 20 basis points. So quite a significant move there to try and stimulate demand.
Many, however, are arguing that with the zero COVID policies, the rates won't be enough to induce buyers back into the market, and that the effects will be minor. What they're arguing is that what is really needed in China is a massive expansion in credit and lower interest rates across the board.
I think what it takes, however, is for credit expansion to accelerate, and it takes more than just a 20 basis points cut in mortgage area. We need to see much more than that.
But it's not clear the extent to which China can lower interest rates across the board, as there is a real growing concern about capital flight, foreign money leaving the country. While China is obviously in desperate need for monetary stimulus, the U.S. Federal Reserve's decision to raise interest rates is causing a lot of money to leave China for the U.S. in the hopes of better returns. Indeed, China has witnessed a record sell-off of its bonds this year, due in large part to better earnings in the West, but also due in large part to a lack of transparency, zero COVID strategy, the real estate crisis, and China's support of Russia.
You don't know the worries I got done.
In response to this capital flight and recent bond sell-offs, China has halted publication of bondholder data That is transaction data of who is buying and selling and how much. Hoping to halt any herd behavior, any stampede of capital outflows, China is only publishing bond transaction data for onshore clients. So if you reside in China, you can still get the data. If you are a foreign investor, a foreign bondholder, that data is no longer available about who and how much bonds are selling.
All information will be given on a need-to-know basis.
So the idea is that if foreign bondholders don't know how many investors are heading for the exits, they will be more likely to leave their money in China. We've talked many times on this channel about China's transparency problems, where we can't trust the data coming out of China. And restricting bondholder data is just going to add to the problem. In fact, it's a sign of a worsening economy and a regime that is not confident about that economy. When the regime has to manipulate the data, when it can't be transparent about the true state of the economy, it's not a good sign for that regime's confidence in the future of that economy. Just look at the inflation data in Canada and the US. So, severely weakened economic output, the worst drop in China's real estate market in the last 16 years, and major capital outflows followed by a restriction in publication of those outflows. Overall, not a great week for China. And as we saw earlier, it's not likely to get any better. The US Federal Reserve is taking a more hawkish tone on the path of interest rate hikes, which will only make the West markets, the markets in the US and in Canada, more attractive for foreign capital than it currently is in China, which is likely to lead to more capital flight. With that said, we'll continue to have updates on how China deals with this real estate crisis, with this growing economic crisis, especially in relation to us here in the West, in the United States, and in Canada. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.